It's my great pleasure to introduce Governor Quarles. Since October 2017, Randal Quarles has been a Fed governor and the vice chair for supervision at the Board of Governors. Since December 2018, Governor Quarles also chairs the Financial Stability Board, an international body that makes recommendations about the regulation of the global financial system. In those capacities, Governor Quarles serves as the lead financial system regulator in the United States, effectively, and the U.S. financial system regulator charged with coordinating global standard setting with other countries' regulators and with international standard setting bodies. After graduating from Columbia University and Yale Law School, Governor Quarles' early career included practicing law as a partner at Davis Polk and Wardwell, working for Nicholas Brady at the Treasury Department during the George H.W. Bush administration, where he focused on the savings and loan crisis and regulatory reform. During the George W. Bush administration, he served first as U.S. Executive Director to the IMF, before becoming Assistant Secretary of the Treasury for International Affairs, and later the Undersecretary of the Treasury for Domestic Finance. Internationally, his portfolio at Treasury included the Argentine default, the reconstruction of Iraq and Afghanistan, Chinese currency policy, and debt relief for the world's poorest countries. On the domestic side, he worked on various financial system policy initiatives, including the reform of Fannie and Freddie, the regulation of hedge funds and derivatives, and proposals for structural reform of regulation. More recently, Governor Quarles was managing director and founder of Sinisher Group, and prior to that, he was a partner in the private equity firm, the Carlyle Group. So as you can see from this diverse and impressive record, there's no American with broader and deeper experiences in both the international and domestic issues relating to financial system regulation. And that experience combines the perspective one gains from both private practice and public service. Since becoming vice chair for supervision, Governor Quarles has shown great leadership at the Fed, finding ways to forge consensus on thorny issues of regulatory reform, notably the streamlining of the Volcker Rule. His most recent speeches grapple with some of the most important and difficult issues the Fed will face in the next few years, including formulating a strategy for shrinking the Fed's balance sheet and reforming stress tests. We are honored to have Governor Quarles speak to us today. Please join me in welcoming him.
Thank you. Thanks. Thank you, Charlie, for that very warm introduction. I'll quote it to my wife when she reminds me that I have once again forgotten that they come to pick up the garbage on Thursday mornings rather than Friday mornings. It's a pleasure to be addressing you all today here at the Shadow Open Market Committee. The SOMC has long served as an important forum for debate regarding the appropriate stance of monetary policy, debates that have often brought alternative perspectives to the challenges that face us at the Federal Open Market Committee as we pursue our dual mandate of maximum employment and stable prices. As Alan Meltzer wrote about his and Carl Brunner's founding of the SOMC, our objective at the time and after was not just to complain about the results of policy actions, we hoped also to improve policy discussion, and I think it's achieved that goal, at least often achieved that goal. This afternoon, I'll briefly remark on the economic outlook and the current stance of monetary policy, and I'd then like to devote some time to a discussion of the approach that the Federal Reserve has taken on the setting of the countercyclical capital buffer, or CCYB, and why I see a setting of 0%, which the board recently affirmed, as the current appropriate setting for the CCYB. And I'll review as well some of the international experience with this tool, given that the CCYB is a relatively new element of our regulatory toolkit. I think the international experience has the potential to provide useful information for us on how the CCYB can be made even more effective in the United States. But first, let me turn to the economic outlook. At last week's meeting, the FOMC left the policy rate unchanged and reiterated its pace and approach towards future policy adjustments. I supported this decision. It's prudent at this point to watch the evolution of the incoming data in determining the appropriate stance of policy, particularly given the indication that growth may have slowed, at least temporarily, in some of the most recent data. That said, I remain optimistic about the outlook for the U.S. economy, And I think that we have the potential to maintain growth at a healthy pace in the years ahead. Now, with regard to the recent data, a sharp fall off in some retail price measures in December suggested a slowing of consumption, the mainstay component of aggregate demand. And while I wouldn't suggest ignoring this decline, it does seem rather inconsistent with a number of other indicators, including credit card transaction data, the continued strength of the labor market, and wage gains in recent months. And the labor market does remain strong. Even with a weak reading in February, the 3-month average gain in payrolls at 186,000 remains above most estimates of the pace of job gains needed to maintain downward pressure on an already historically low unemployment rate. As with retail sales, the February payroll number seems a bit odd, especially when measured against the continued strength of the household survey for the same month. That said, weak February payrolls are another reason to continue patiently watching the data to see how conditions continue to evolve. But looking past the near-term data, I see many reasons to expect relatively strong growth in the coming years, supported by gains in the productive capacity of the economy. Regarding the inputs of production, I've been encouraged by the increase in labor force participation over the past year. After a period of subdued growth, investment was also strong last year, with spending on equipment and intangibles rising 7.5%, increasing the capital stock and adding to the productive potential of the economy. Though some recent investment data have been less robust, these data are volatile, and I expect continued gains supported by profit growth, continuing impetus from incentives in the tax bill, and a generally favorable business environment. Most important, I've been encouraged by the recent step up in labor productivity growth. Last year's increase of almost 2% marked the strongest growth since the immediate aftermath of the financial crisis and was well above the 1% pace that prevailed in the preceding 5 years. I think there are many reasons to believe that this faster productivity growth could be persistent. My expectations for further increases in capital spending is one. For another, it could be that tight labor markets have played a role in boosting labor productivity growth as employers work to increase efficiency as new workers become harder to find. Turning to inflation, given the volatility and idiosyncrasies of the data, I view the current reading on core PCE inflation at 1.8% as being roughly consistent with our 2% objective. Overall, inflation pressures are muted, but I don't believe that the seeming unresponsiveness of inflation to the apparent tightness of the labor market and other aspects of the economy tells the whole story in evaluating slack versus constraint in the economy. Of the many explanations for this phenomenon that have been offered, one possibility that we have to keep in mind is that inflation has remained stable precisely because of the public's confidence that the Fed will maintain a framework that keeps the economy from overheating and inflation from rising significantly above the 2% benchmark. Inflation could then, for some time, remain quite stable in the face of an economy running hot. But if public confidence began to erode because of Fed inaction, a possible consequence could be the de-anchoring of inflation expectations rather than a gradual and controlled move to an inflation rate sustainably around our 2% goal. Of course, there are a variety of alternative explanations for the current surprising relationship between inflation and unemployment. Perhaps all of them are part of a full account. We should also be wary of a material and durable downward drift in inflation expectations below our objective. And were we to see that develop, perhaps due to secular changes in the formation of prices or perceived constraints on the ability of monetary policy to react to future downturns, we would have to take that into account. Either way, as a matter of prudent risk management, we must conduct policy in a manner consistent with keeping inflation near target, validating the public's trust in our commitment to our inflation objective, and keeping inflation expectations anchored. With regard to policy, I'm very comfortable remaining patient at this point and monitoring the incoming data. That said, my sense is that further increases in the policy rate may be necessary at some point, a stance I believe is consistent with my optimistic view of the economy's growth potential and momentum. In the language of central banking, My estimate of the neutral policy rate remains somewhat north of where we are now. Communicating a data-dependent policy framework can be challenging, especially if we don't want to appear to be overly discretionary. It would probably be clearest if we defined what data we were dependent on and how we depended on those data. That is to say, if we adopted a monetary policy rule. Strict rules, however, to achieve their valuable heuristic benefit, are as much about ignoring some data as they are about paying attention to other specific data. And indeed, while rules provide useful and important benchmarks, the complexity and evolving nature of the economy at the current juncture argue for the consideration of a wide range of indicators in assessing the state of that economy. But this, in turn, can complicate the communication of data dependence. How can we adopt and convey a clear strategic stance on policy while maintaining our credibility if evolution of the data requires an evolution of the strategy? I prefer a framework where we make it clear that we're focused on broad trends. Elsewhere, I've used the aviation analogy that we shouldn't chase the needles on the instrument panel. We should be clear that while we respond to clear and durable evolution in these broad trends, we're not reacting to every piece of volatile data every quarter. Let me now shift gears and return to the countercyclical capital buffer, beginning with how it fits within our broad set of efforts to promote financial stability. The core of that approach has been to establish a set of structural, through-the-cycle regulatory and supervisory standards to ensure resilience against a broad range of shocks. In contrast to the pre-crisis framework, banks, especially the largest and most systemic banks, are now required to maintain substantially higher and higher quality loss-absorbing capital and other cushions. Stress testing examines the resilience of large banks to severely adverse economic conditions. Liquidity requirements and regulatory incentives to limit reliance on short-term wholesale funding have reduced funding risks among large banks and their affiliated broker-dealers. And resolution planning requirements reduce the risk that the failure of a large firm would spill into the broader economy. Outside of the banking system, money market mutual fund reform has reduced this sector's susceptibility to destabilizing runs by investors. And requirements that many derivatives be centrally cleared have decreased the opacity and interconnectedness that contributed to the chaos of 2008. In addition to these through-the-cycle measures, the Federal Reserve actively monitors for the buildup of financial stability vulnerabilities, and we can require large banks to increase their loss-absorbing capacity through increases in this countercyclical capital buffer when systemic vulnerabilities are sufficiently large. Now, while such countercyclical tools are new, their goal is to mitigate the buildup of vulnerabilities during buoyant periods, since experience has proven time and again that vulnerabilities can build during good times as risk appetite grows and memories of earlier instability fade. Effectively mitigating the buildup of risk through the CCBYB requires a systematic framework for analyzing vulnerabilities and a mapping of such changes in financial sector risk into an appropriate level for the CCBYB. The board developed its framework outlining the objectives of the tool and the factors that would influence the determination of its appropriate level through a process of public consultation. And under the policy developed, the primary objective for activating the CCBYB is to build financial sector resilience during periods when the risks to financial stability have risen to meaningfully above normal levels, and there's an elevated possibility of potential losses within the banking sector that could place strains on the supply of credit or otherwise substantially impede economic and financial activity. A secondary objective for using the CCBYB is its potential to limit the buildup of financial vulnerabilities by slowing the rate of credit expansion. That is, the possibility that the CCBYB may lean against the wind of credit fluctuations. But this secondary objective, both in the original discussions in Basel about the international agreement around this tool and in the Federal Reserve's formally adopted framework, is less central. A notable feature of the board's current framework is the decision to maintain a 0% CCBYB when vulnerabilities are within their normal range. Because we have set high through the cycle capital requirements in the United States that provide substantial resilience to normal fluctuations in economic and financial conditions, it's appropriate to set the CCYB at 0 in a normal risk environment. And thus, our presumption has been that the CCYB would be at 0 most of the time. So what then would be appropriate given this framework to activate the CCYB? That is, how do we know when financial vulnerabilities are elevated? Well, at the Fed, we continuously monitor vulnerabilities, as highlighted in our recent financial stability report. And our approach is organized around tracking 4 broad vulnerabilities that academic research and practical experience have shown can amplify negative shocks and result in outsized losses in the real economy. These are asset valuation pressures, household and business debt, funding risk, and financial sector leverage. As part of this process, the board considers a number of quantitative indicators, one of which is the credit to GDP gap proposed in the Basel Committee guidance, that are indicative of potential vulnerabilities. Nonetheless, judgment has to play an important role in this process, especially in assessing how interactions between vulnerabilities may serve to mute or amplify the transmission of different kinds of shocks. The framework requires further judgment as to whether the CCYB is the most appropriate tool to address the particular areas of concern as they arise, which will depend on, among other things, the extent to which banks subject to the CCYB are exposed to vulnerabilities or contributing to them. Assessing the current state of financial vulnerabilities is thus a critical part of the decision on whether to activate the CCYB. So let me briefly give you my view of each of those 4 categories in turn. Asset valuations increased to the high end of their historical ranges in many markets over 2017 and the first half of 2018, supported by the solid economic expansion and an apparent increase in investors' appetite for risk. The market volatility and subsequent rebound have muddied the picture somewhat, but it does seem that valuation pressures have eased to some extent. In a particular locus of concern, the market for leveraged loans, that is, syndicated loans to lower rated or unrated borrowers with already significant debt loads. Now regarding debt outstanding. Borrowing by businesses has reached a historically high level relative to the size of the economy or business assets. And there are also signs of deteriorating underwriting standards. Of course, this has happened at a time when corporate profits relative to the size of the economy are also quite high, mitigating some of the concern that this might suggest. But the riskiest forms of business debt have increased the most amid such signs. These developments could potentially leave the corporate sector vulnerable to a sharp slowing in economic growth. Although we think the banking sector has only limited direct exposure to such borrowers, and to the extent they can be measured, indirect exposures are also limited. The notable levels of vulnerability in asset valuation pressures and business borrowing must be considered alongside modest vulnerabilities associated with household borrowing and the historically low levels of financial sector leverage and funding risk. Household debt relative to GDP has fallen substantially from the level of a decade ago, and the credit quality of household borrowing remains relatively solid, despite pockets of weakness evident in some areas of auto lending. Even more important, banks now have substantially higher quality capital and more of it than in the 2000s, owing importantly to the structural reform of capital requirements and stress testing. In fact, under last year's stress tests, capital levels at the largest US banks after a hypothetical severe global recession would have been higher than the actual capital levels of large banks in the years before the crisis. Moreover, around 20% of the assets of the most systemically important financial institutions are highly liquid assets that can be sold quickly in the event of stress. And following reforms to money market mutual funds and other steps, the volume of short-term uninsured funding, most prone to runs, is well below pre-crisis levels. Taken as a whole, financial system vulnerabilities strike me as being not outside their normal range, which is consistent with a zero CCYB under the board's framework, and is why I supported the board's decision to keep the CCYB at 0 earlier this month. But while policymakers in the United States have maintained the CCYB at 0 since 2016, Other countries have adjusted their countercyclical capital buffers in response to vulnerabilities within their financial sectors. Currently, 13 countries have announced a CCYB above zero, ranging from 0.25% in Luxembourg to 2.5% in Hong Kong, Norway, and Sweden. The CCYB is a novel approach to financial regulation, and I think it's important that we, as regulators, learn from other countries' experiences with the CCYB. I see three important explanations for differences in the CCYB across countries. Perhaps the most important and direct reason for different CCYB levels among different countries is that they face different vulnerabilities. According to national authorities' announcements, the decisions to activate the buffers were generally motivated by credit growth, household debt, and housing prices. In this regard, it's notable that mortgage credit or house prices have expanded rapidly in several countries deploying the CCYB, including Hong Kong and the Nordic countries that have set their CCYB at 2.5%. For example, the Hong Kong Monetary Authority's decision to increase the CCYB level to 2.5% in January of 2018 was importantly linked to housing developments. Another explanation for differences in the observed CCYB levels across countries is the range of available macroprudential tools to stem the buildup in financial vulnerabilities in different countries and the degree to which such tools have been the preferred means for addressing identified vulnerabilities. For example, housing market booms, as noted above for Hong Kong, have been a concern in several countries in recent years. But accordingly, some national authorities have used macroprudential tools focused on housing, such as caps on loan-to-value ratios, to try to increase the resilience of borrowers and to indirectly strengthen the resilience of the banks and the financial system should their housing booms turn to busts. For example, policymakers in Canada have not activated the CCYB in response to concerns about housing market risks, but they have lowered the maximum loan-to-value ratio for various mortgage products and capped debt service to income ratios. The availability of such alternative tools for limiting systemic risk may be among the factors influencing the decision to adjust or not adjust the CCYB in a number of countries. In this regard, it's notable that the set of macroprudential tools in the United States is limited relative to that in many other countries. Finally, another difference, one that's particular to the United Kingdom, is the framework adopted by the UK Financial Policy Committee to integrate the CCYB with its structural capital requirements. Specifically, under the Financial Policy Committee's framework, the CCYB would equal 1% in standard risk conditions. In normal times, it would regularly be turned on. But to avoid having this be a significant increase to already very high levels of capital, the FPC undertook a one-time adjustment to its other capital buffers in order to offset part of this increase. The effect of this policy is that the buffer can be varied both up and down in line with changing risks that the banking system faces over time. This approach is an interesting deviation from the idea in the original Basel discussions and the framework adopted in many other jurisdictions, including the United States, in which structural capital levels are set at high levels aimed to deliver the desired level of resilience, with the CCYB raised to positive values only at times when vulnerabilities are above normal. In practice, the UK framework appears to have provided the FPC with additional flexibility, as it has adjusted the CCYB with evolving financial risks associated with, most obviously, Brexit. As I examine this experience, systems similar to the United Kingdom's, where the CCYB is positive during normal times, may allow policymakers to react more quickly to economic, financial, or even geopolitical shocks that occur amid otherwise normal conditions, without relying on the slow-moving credit aggregates contemplated in the original Basel proposal. Moreover, this setting of the CCYB permits more gradual adjustments in the CCYB, especially in periods with a high degree of uncertainty about the level of financial vulnerabilities. Another possible benefit of a system that has additional flexibility is the ability to coordinate the setting of the CCYB with the setting of monetary policy in situations where such coordination is valuable. At the same time, I wouldn't expect such situations to be the norm, as the objectives and governance of monetary policy and macroprudential policies are separate for good reasons. So to conclude, in the United States, we built a substantially safer financial system, by focusing on using structural tools that confer through the cycle resilience. With that construction work largely behind us, attention naturally turns to the set of time-varying financial regulations, particularly the CCYB. The overall capital framework in the United States has been designed to ensure high capital levels without having to activate the CCYB, with the implication being that the bar for activation would be a high one. But as a result, much of the time there would not be any buffer to reduce if conditions were to precipitously deteriorate. The United Kingdom's approach to setting the CCYB also relies on having a high overall level of capital during normal times, but by swapping some portion of static capital for CCYB in reaching that high capital level during normal times, and thus making some part of that capital part of a releasable buffer, UK policymakers have built in more flexibility to move buffers down in time of stress. Other countries provide additional data points in terms of possible ways of approaching the CCYB. With the CCYB in active use around the world, I'm confident that the academic and policy communities will learn a great deal about how best to use this new tool to build a more resilient financial system. Thank you for having me today, and I'm looking forward to taking a few questions.
So Governor Quarles is going to take some questions. Have we got someone? We'll start with Athanasios.
Thank you very much. This was two speeches in one, but I will focus on the second part, on the counter-cyclical buffers. Of course, some of the issues about discretionary monetary policy are related to the issues of discretionary supervisory and prudential policy, including the setting of prudential buffers. And in a similar vein of thinking about the ability of policymakers to fine-tune the exact timing of adjusting capital ratios up and down relative to simpler rules, I was wondering if the Federal Reserve has managed to come up with some evidence that having a fine-tuning instrument of the counter-cyclical buffer in real time, with the uncertainty in measuring the conditions that are necessary to implement it correctly, would be better rather than permanently raising the capital ratios by the equivalent amount that you would want through the cycle. I say this because you mentioned the difficulty of assessing when exactly the Federal Reserve would need to adjust these ratios, and you pointed out that the Fed is monitoring financial conditions very closely. But I remember vividly when I was still at the Federal Reserve in the spring of 2007 that we were monitoring financial conditions very closely at the time as well. And it doesn't always work very well.
So I think that's a good point, and I think that's why the Fed's framework is set with that in mind. That I think the principal difference with the UK framework is precisely that because of the difficulties in judging exactly the level of financial vulnerabilities, when they will be meaningfully above normal, that sort of standard, quite high capital levels, permanent capital levels, is the basic approach. And that you would therefore only need this CCYB in unusual circumstances, and that you need to have a fairly methodical framework as opposed to kind of relying on a gut feel as to when you're going to turn that tool on and when you're going to turn it off. So I think that the current framework responds to those concerns fairly well. The issue is that in that framework, the British experience with Brexit, I think, has been instructive. Now, whether it would lead to any change in our framework would be far too early to say. We haven't even begun thinking about such a process. But they believe that since they are the country that has been most active in handling the CCYB, they turned it on, they turned it off immediately after the first Brexit referendum. They've turned it on again, they've turned it back down. I think they moved it a few times. And their experience has been that it has been of value to have some element in the capital stack that can be varied in response to a downturn. And it plays, at least observing it, they don't quite talk about this in the way they describe their framework, but it appears to be operating in a way that's almost as much in response to macroeconomic conditions as it is to financial stability concerns. And that's a valuable tool. We don't have the ability to do that, were we to seek to do that currently. Because our capital levels are permanently high, because of these concerns about judgment and discretion that you've appropriately articulated, except in very unusual circumstances, we won't have a flexible element in order to turn down should we find that valuable at some point in the future. Now, does that mean we should change our framework? I don't have a view about that currently. But I do think that that's an interesting international data point to think about as we think about the sort of real concerns you've raised.
You're in the front, sorry, you're first.
Hi, I'm Tony Mace with Mace News. Just before you arrived, we heard a bit of a critique of the Fed's communications approach. How would you assess the effectiveness and appropriateness of the Fed's communication strategy?
Well, I think that obviously all the members of the committee, I mean, the Fed has placed a significant priority on communicating regularly in clear language, on increasing the amount of communication. And I think that the communication of policy in general has been pretty good. I do think that there are instances where some aspects, some of our communication tools have been overinterpreted, despite all of our efforts to ensure that they only mean what they are supposed to mean and not more than that. The dots are probably a significant example of that, the SEP in general. I think there has been some tendency among markets and Fed observers to over-interpret what those are, but I do think that they form, when properly regarded, an important element of a good communications policy, and that our job is to continue to describe what it is that we're doing in language that is as clear as possible, and we'll continue to keep doing that.
Yeah, thank you, Mr. Vice Chairman. So I'd like to pick up on one of Mickey's excellent points from earlier on, that so much of what the FOMC is doing is looking at things that are beyond monetary control. When we look at what the BEA reports about hard goods prices, they've been falling for about a quarter century now. Your predecessor at the FSB, Mark Carney, has observed that most of so-called inflation is really non-monetary government policy inflation. He calls it policy inflation. And then you've got a whole list of papers, everybody on a wide spectrum, talking about how so much of the core PCE that you mentioned is really artifacts. Janet Yellen talking about healthcare, Austin Goolsbee and Pete Klenow, the whole list that we see at the ASSA conference. Given Mickey's good point, how much can the Fed, the FOMC, really be looking at that measure when so much is non-monetary?
Well, on the other hand, our statutory mandate is stable prices, and whatever the factors that feed into that, well, we have a certain set of tools to affect that. I do think that we need to be looking at what is our objective. We only have the tools that we have to achieve that objective, but But I think that that is nonetheless what we have to be targeting and aiming at. Our objective is to maintain stable prices, so we have to look at those measures of inflation.
Chair Quarles, thank you very much for your comments. One of the things that the banking system has been very successful at in the last 10 years has been deleveraging. And so my question is, to what extent do you think you can keep the CCYB at zero because the banks have deleveraged and hence have a lot less risk on their balance sheets? But the offset to that has been the substantial growth in the investment grade and high yield bond markets. So it's outsourced, if you like, some of that risk to the private sector. So in the next downturn, whenever that may be, if the private sector doesn't support the investment grade and high yield markets, the pressure ends up coming back to the banking system at some unknown rate, and then the demand for balance sheet and risk goes up substantially. Outside of the traditional monetary policy that the Fed can do, but is there really anything you can do with the CCYB at that point, because we've seen there's systematic change in where risk lives, since 2008?
So the question, so I think you've hit on a very good point about the Fed's framework for assessing when the CCYB would be turned on, precisely because the amount of financial sector leverage is so low historically. That's really going to outweigh most of the other of the four factors. So we have elevated asset vulnerabilities, we have elevated business debt currently. But if you have a framework that determines our aggregate vulnerabilities meaningfully above normal, that's going to be very hard to get to with a banking system that we have, that has so much more capital and liquidity than it had before the crisis. It's going to be hard to get to meaningfully above historical levels, which means it's going to be hard to turn the CCYB on. But the CCYB is not intended to be in the current framework, it's not intended to be a macroeconomic tool, if you will. It's a financial stability tool. And if the sort of highly runnable banking sector is that much more resilient, then it certainly is the case that there can be losses elsewhere in the system from some of this debt that can lead to macroeconomic consequences. As we consider the outlook and what the appropriate stance of monetary policy should be, we should take all that into account. But if those macroeconomic events are unlikely to lead to financial instability, as opposed to simply a downturn or perhaps an amplification of a downturn, then in our current framework, the CCYB wouldn't be the right tool to respond to that. We would have other tools that ought to respond to it. We have to think about that in a different way. Now, as I've said, the UK, although they haven't quite articulated this view, they've articulated a change in their framework, but it does appear to be an evolution towards using the CCYB as perhaps an element that could respond to more macroeconomic concerns, to try to dampen amplification of macroeconomic trends as opposed to financial instability trends. And whether that's something we ought to be thinking about, I don't know.
Front here.
Hi, thank you. I'm Harry Follick with New York State Government. The Fed has the inflation rate, as traditionally measured, seems to be below 2% by a little bit for several years. And there seem to be some commentators in the field who are saying, well, since it's been below 2% for a while, if it went above 2%, maybe that's not really a problem. It's just compensating for perhaps what it didn't do previously. Do you think that the Fed would be okay with that? I mean, if the rate went above 2%, do they feel that would just compensate, or would that become a bit of a danger signal?
No, we've articulated a symmetric 2% target, a symmetric view of our 2% benchmark, and there can be a lot of angels dancing on the head of a pin as to how one interprets symmetric. But I at least believe, and I think that I at least believe that it means that we ought to be comfortable if inflation were running, mildly above 2% for a period, just as I am comfortable with inflation running very mildly below 2% currently. 1.8% is, given all the variability and idiosyncrasies of the data, it is effectively 2. So I don't, and therefore 2.2% would be effectively 2. And so if inflation moved in that direction, I don't think that we should be concerned, and I think that's the articulated policy of the Open Market Committee. The more complicated question as to whether one should target moving above 2% or try to make up for a longer period if you've been below 2%. If you've been at 1.8, do you need to be at 2.2 for some period? And some of these, we'll be having a discussion around those sorts of issues over the course of the next number of months on the committee, and I'm looking forward to, there are differing views among the committee. I'm looking forward to having them fleshed out and more fully articulated. We've obviously had some conversations about it now and among individual members of the committee. My own view, as I think I've said before, I begin from a stance, although really I don't want to predict or preempt any of the discussion, very open to being persuaded, but I come from the American West, and if you're bow hunting an elk and you miss 1 foot to the right, you do not establish your credentials as a hunter by missing 1 foot to the left. So, but I'm open-minded.
Well, I'm going to interject a question, and it's about the LCR. So currently, what I'm hearing, and I've also read your speech on the topic of shrinking the Fed's balance sheet, a lot of the discussion about Fed reluctance to shrink the balance sheet is now referencing demands for excess reserves, which are driven by 2 aspects of the LCR enforcement. At least this is what market participants are saying. One of them is the uncertainties of being able to predict their LCR, which of course is a regulatory phenomenon. That uncertainty is not coming from God, it's coming from the regulators and from the implementation of the Basel standards. And then the second aspect is murmurs that supervisors at the Fed are requiring in the enforcement of the LCR more reserves than Treasury bills, even to the extent that under the Basel standards they would be substitutes, so that there's a kind of Fed view that reserves are better than Treasury bills, and that the uncertainties coming from those 2 regulatory aspects are a major driver for, I won't call it an excuse for, but a driver of the reluctance to shrink the balance sheet, which many of us find concerning. So, put the point more pointedly, why doesn't the Fed remove the real problem by reducing the uncertainties associated with those 2 aspects of the LCR enforcement?
So that's a very good question. A significant part of the uncertainty that we have about what sort of stable reserve demand will be post the crisis is driven by the uncertainties of the banks as to what we're going to require with respect to reserve demand. I think the second one is probably easier to answer than the first, which is that there should be no supervisory preference for reserves over Treasury securities. I think that's and we're trying to communicate that very clearly. I also have heard that when you go out and talk to the supervisors, they say, nope, not me. But in the process, we're reinforcing that we shouldn't have that sort of behind-the-scenes preference for reserves over treasuries. There are some measures that we might consider that could, in fact, further increase the bank's own mild preference for reserves over treasuries, because there is some transaction costs, some friction in monetizing treasuries, even though they are, they're eminently monetizable. There is some friction in doing that, and so you would expect, even absent a supervisory expression of preference, that there would be some level of bank preference for reserves over treasuries and thinking about their own desires. But there may be things that we can do that will limit that as well and try to make those as interchangeable as possible. And I do think that to the extent we do that, we'll find that what banks currently estimate as their own stable reserve demand will be lower than they currently think that it's going to be. I mean, as most of you in the room probably know, before the crisis, reserve demand, the demand of banks for reserves was about $50 billion. And currently, we're estimating that, about 1.2 trillion is what we think that the stable demand for reserves would be, and that's on the basis of surveys that we do of the institutions that that are wildly above what the pre-crisis demand for reserves was. Now, we've been operating in an environment where it's hard for them to determine really what their stable demand of reserves is going to be in a more normalized world, particularly where you could eliminate some of these structural differences, minor though they may be, between reserves and treasuries. So on the structure of the LCR itself, it's something that I do think that we have to look at. We should be ensuring that we have, that we have ample liquidity, but try to avoid sort of structural elements that cause that liquidity to be even much higher than what we already think are ample levels. And we are working on trying to do that.
Thanks for those answers. It's very helpful. Other questions? There's somebody in the back.
Nisagwa, Pace University. Who is watching the shadow banking system and how is it being watched?
So there are a number of answers to that question. The sort of most broadly at the FSB, that is a topic of regular examination. There's a regular report on the shadow banking system. We now, I will call it the artist formerly known as the shadow banking system. I believe the internationally correct term is non-bank financial intermediation currently, and which obviously is a critical part of the financial sector, not just in the United States, although mostly in the United States, but increasingly so around the world, and a topic of close monitoring from the point of view of the regulatory system, of the international regulatory system gathered at the Financial Stability Board. Domestically, we also monitor developments there at the Federal Reserve. It's part of our assessment of vulnerabilities. I think it's still the case that our principal tools for addressing that sector are the connection points between that sector and the regulated banking system. And we do have a reasonably good handle both on what those exposure points are, and we can affect evolution in the non-regulated sector through steps that we take in the regulated sector. For example, most leveraged loans are, if they're originated in the banking sector, they're sold off into the non-banking sector, into more stable holding structures such as CLOs. We look at those structures. We try to see if they're evolving to be less stable. That doesn't appear to be the case. We try to understand what the potential for reverse exposure into the banking system is. Are banks, having sold them off, do they now have exposure to the CLOs that might cause a decline in value of those CLOs while those structures are not subject to runs, to result in some concerns about the banks which are subject to runs, and that could lead to financial instability. We look at that. That doesn't appear to be the case in the United States, but we're less sure about what that is globally. Are there other banking systems that might have been purchasing more of this CLO exposure as the US banks have been offloading it? Might that create some potential for global instability that could feed back into our system? And at the FSB, we've begun a project this year to look at exactly that. Where are these global exposures? Who owns the CLO exposures around the globe? To consider that question. So, so there are measures that we can take, mostly related to how we regulate the regulated financial system, and it's something that we monitor very closely, both in the U.S. and globally.
This gentleman here.
Kevin Chen and from Horizon. Can you comment, Governor, about the recent major decrease of the long-term Treasury rate since last FOMC meeting? Is it a concerning signal And also, does it mean, if you look at banking stocks, they've declined quite a bit. People expecting banks are going to make much less money going forward because of the yield curve inversion. Thank you.
So the yield curve inversion is an interesting topic. On the question of how it actually affects bank profitability, careful studies over the years, banks generally manage to, even in periods of extended yield curve inversion, have generally managed to, been able to manage their net interest margin in a way that maintains profitability, even if it might be somewhat less. So historically, at least, kind of the direct concerns about the effect of a flat or inverted yield curve on bank profitability don't seem to be as great as sort of first principles would suggest that they might be. If you're borrowing short to lend long, it's not 100% clear how you can make money if the curve is inverted, and yet banks generally have during periods of yield curve inversion. There are ways that they can manage them. As to whether the fact that the 3-month 10-year curve has inverted, and of course it's moved back and forth a little bit, whether that's historically in the United States that has been a signal of recession, ought it to be now? For me, I think you have to look at that symptom and look behind to some theory as to what might be causing it. So for example, if my skin is warm to the touch, I could have a 24-hour bug, in which case I should stay in bed and take some NyQuil. I could be dying of cholera, in which case I should have some intravenous antibiotics immediately, or I might just have been sitting out by the pool for an hour, in which case I should wear sunscreen and a hat. Same symptom, entirely different responses, and if you look at what my view at least as to a base case as to what would be leading to a flat or occasionally inverted yield curve currently is that in a normalization cycle, historically always short-term rates have risen faster than long-term rates have. The curve always flattens during such a cycle. We'd expect that to be exacerbated by our, by the current size of our balance sheet. Again, as we kind of grow into our pants on the balance sheet, that will be pushing down on the long end for some time before that kind of normalizes. So I think that those are the factors that are more driving the current slope of the yield curve than what historically may have been factors that suggested that the markets at least expected a recession in the future. So I don't view it as much of a harbinger as others might.
Hi, I'm Doug Carr with R Street Institute. Combining the balance sheet and maybe a little bit of a yield curve, there seems to be a contradiction. On the one hand, you want a large balance sheet. Obviously, for 100 years, the size of your balance sheet was related to the level of real interest rates, and that's a significant correlation. We have a depressed level of interest rates relative to what the Fed and many of us in the market expected natural rate would be. And quite possibly the large liquidity overhang from your balance sheet is influencing that. So how do you resolve the contradiction between the potentially depressing effect on real short-term rates of a large liquidity overhang from your balance sheet and your desire to get interest rates back to a normal level?
So it's a good question. I think we have to put it in context, and it's a context that I hadn't really even focused on until recently in the past few months, and I'm sure that most folks in this room have focused on it probably more than I had. But the balance sheet as a percentage of GDP, which really is the right way to think about the size of the balance sheet, right, has shrunk pretty significantly, and since the time of the crisis. I mean, at its largest, it was about 25% of GDP. It's shrunk to about 17% of GDP. I'm doing this off the top of this next figure. It's off the top of my head, but I remember when I came into the Treasury in the Bush 43 administration, at the beginning of Bush 43, the math was very easy because we had a $10 trillion economy. And the size of the Fed's balance sheet was just under $800 billion. So you had about a 12% of GDP balance sheet. So it was 12% kind of steady state before. It's at 17% now, down from 25. That's higher, that's elevated. But it's not quite what I would have said even 6 months ago, sitting inside the Fed and looking at the balance sheet. It's not as dramatic an issue because of the growth in the size of our economy. Certainly since most of us were kind of thinking, what is the natural steady state of the size of the balance sheet? So I think in our current framework, the idea is that if you set the current size of the balance sheet and you hold it steady for some period, it will continue to shrink as a percentage of GDP in a way that is probably less potentially concerning to markets and so forth, because it will only shrink as a percentage of GDP as GDP is growing, as there's a positive environment surrounding it. But over time, it will inevitably shrink if we are holding it constant as a percentage of GDP. That's what I would like to see and would expect to see happen. Importantly related to that, of course, is at what point is how we are working to determine the ultimate demand for reserves, which is the principal variable in what the size of our balance sheet can be, and what that ultimate level of reserve demand finally turns out to be. So I think we need to continue to push on that even as we're holding our balance sheet constant. And the way that would work, I know this is elementary to all of you, but the way that would work is, as demand for U.S. currency continues to rise, which it does seem to continue to do. I don't perfectly well understand why that is the case in an increasingly digitized world, but we have a quite predictably constant increasing demand for currency, which will drive an increase in the size of the Federal Reserve's balance sheet as an offset to that liability. And if reserve demand is found to be lower and lower and currency demand increases to offset that, we'll be able to hold the size of the balance sheet constant for a material period of time while GDP growth is shrinking it relative to GDP. So we've already accomplished a lot of that shrinking. 25 to 17%, that's 8. And if we were to get it back down to 12, that's only an additional 5% shrinkage. So that's the way I think about it. I wouldn't pretend that that's the universal way of thinking about it on the committee, but I think that's a good way of thinking about it.
We have time for one last question. This lady in the front.
Hi, I'm Alice Ford. I'm with The Economist. There seems to have been a sort of push at the Fed to sort of streamline and tailor some of the regulations that have appeared post-crisis, whether this is sort of clarifying stress testing or streamlining Volcker, raising asset thresholds. In your opinion, has this resulted in a meaningful deregulation of the banking industry, and which of these regulatory changes do you think is the most important?
A very good question. So I do think that the changes that we have implemented or proposed, and others that we will implement or propose in the future, this is kind of an ongoing program of working through these, will result in a meaningful increase in the ability of the financial sector to support the real economy. They will make a meaningful difference. But I've tried to refer to the project, the way I think about the project is that this is recalibration as opposed to relaxation. Post the crisis, we have, the fact that we have materially higher levels of capital, that we have much more liquid institutions, that we worked hard to improve the resolvability of these complex, large companies so that policymakers in the future will feel that they have more options. Only in the future will they be able to decide what they do with those options, but I do think we have provided them more options in the event of some dramatic stress in the future. All of that is very important, and the objective should not be to say, okay, that was a mistake and we need to get rid of all of that. But it was an incredibly complex project. It was a decade-long project involving much international negotiation, and inevitably involves compromise and different views. And if the outcome of that, exactly as it fell, was the best way that one could accomplish these important objectives of higher capital, higher liquidity, and improved resolvability, it would be the first time since man was ejected from the garden that we had been so successful in a project of such complexity. So I think it's incumbent upon any serious institution to now take the fact that a decade on, we've finished implementing this. Now, how can we improve the efficiency with which these goals have been achieved? Some cases that will be minor tweaks, tweaking calibration. In others, it may be a change in framework. Others, it may be there may be cases where two rules are pointing in different directions. There may be pure reductions of administrative burden. There may be, and I could go on. There are examples in what we've done of each of the ways in which you might improve the efficiency of the system. Some of it pure cost, some of it in reducing unintended and perverse incentives. And we've tried to address all of that. And at the end of that process, which will be a few years process, I do think that will have been, as you asked, will that be a meaningful change? Yes, I think that will have been a meaningful change. But it won't have been a relaxation of the objectives or goals of regulation. I think it will have been a responsible evolution, which would be improper to shirk on the grounds of course, every time we change any dial, there's immediate political criticism of, you're stepping back, you've forgotten there were people at my confirmation wearing T-shirts, don't take us back to the crisis, So it would be irresponsible for us to allow that criticism to prevent us from doing the necessary job of appropriately calibrating the system.
Well, on that note, I'd like to take the opportunity on behalf of everyone here to thank you, Governor Quarles, for a remarkably informative, substantive, and candid presentation. Thank you so much for coming.